Welcome everybody, good morning. Welcome to the summit. My name is Orlando Satola. I'm the Technology, Media, and Telecommunications sector leader for our M&A services at Deloitte. So I wanted to welcome you. I'll be moderating a panel. In a few minutes, I will allow for some introductions here as well. I thought I'd start with some level setting or some intros here in terms of what we want to accomplish today. Obviously, our topic is investments in M&A and media, entertainment technology, broadband, social networks, mobile gaming. I might as well just say everything. We've covered it all. So hopefully, we've got 5 good speakers here, panelists, and I think you're going to be impressed with the level of discussion on those topics. But I thought I'd do some intro and a lead into our session here, and then do a shameless plug for one of our marketing pieces that we're putting out, a research piece. And so Deloitte puts out a digital democracy survey every year, and it is a survey of about 2,000 or so respondents who are broad spectrum across broad demographics and also geography. So it's not only U.S., but it's international as well. And we use that piece to gain insights into the telecommunications media sectors, and really focused on media in particular and media consumption patterns. And so I'll start with some of the observations that we have in there. And the piece covers probably, it's in totality 1,000 different questions and topics and areas. It's our 9th year of doing it. So we've got a good history and a trend that we're seeing. But I'll hit sort of 4 topics that I thought were sort of relevant to our topic this morning and really interesting to this group. And some of them might be, something that you're already familiar with, but some of them also might, set the stage for the discussions that we're having here. And so one of the observations in our survey that we've done now is the increasing importance of broadband to our consumers. And so if you ask our consumers, what is the #1 service that they subscribe to? What is it they can't live without? What is it that they would be willing to give up their coffee habit or Starbucks habit for? That's broadband connection, both wired to the home and wireless, and increasingly wireless. And so you see, as you saw recently, a $40 billion auction going on for additional spectrum. And so that wireless segment is important. We all want to be connected all the time. And so that's one of the major trends that underlies the investment phenomenon that we're talking about here. The second is the devices. So you have the technology of devices going on, and all of us are moving into a device world. Almost every person here probably has their smartphone. And so the combination of the connectivity and the devices is creating an enormous demand in other services, and I'll get into that next. And we have a concept we call digital omnivore. So digital omnivore is a group of people who would be not only a smartphone user, but a tablet user, a laptop user, and probably many devices in their household. So I'll just go out and limit here and say, okay, how many people in this room, if I show hands, are digital omnivores under Deloitte's? And so I'd expect nothing less in this particular group, but the study will tell you that we're still not at the majority of the folks, but we're pretty damn close. And so that's a pretty big move from even a few years ago when less than 10% of the population fell into the digital omnivore segment. So that fuels the demand for, what are we going to do with these devices? What do we do with all this connectivity? And the 3 biggest areas, very logical to the topics we're talking about here, is the demand for entertainment and more video. So video is kind of the big thing that everybody wants. It's coming through in our studies. It's escalated each year, and is the driver for a lot of other things. Social networking is the next area. So okay, the second biggest thing we're looking for is social networking. And third thing, and doesn't get as much press, is gaming. So all of our respondents, or a good number of the respondents, are into the gaming area. And that's not only the market driven by consoles or console players that we have, but also now increasingly the mobile gaming environment. And it's really a new market as opposed to stealing from the old market. Because in that market, we're seeing, a lot of women who are using that. So they're predominant users of gaming on the mobile handset. All of that driving some other phenomena. So the last thing I'll say is that increasingly consumers are willing to give up in some personal information. And we've always had a sense of personal information being given up for purposes of subsidizing through ads to give you free content. But I think increasingly people are most interested in getting content that's directed at them. And so they're willing to give up some of their personal private content and video channels directly to them. And that underlies the concept of not necessarily disconnecting the cord, but disconnecting from our traditional pay TV services, channel specific or multi-channel specific listed in as Zoomer. And the other concept is that in our survey, we find that most of the folks would respond positively that they don't mind advertising as long as it's advertising specific to the area of interest for them. And so if your passion is golf, as I've come to say, I'm happy to see commercials around golf and golf events and golf, whatever the topic might be, but I don't really want to see something else. And that's advertising that I'm opting into, I'm interested in, and I'm happy to pay for a channel to get that. So those are some of the major themes that we're seeing in our digital democracy. I thought I'd review that because I think it leads quite nicely into our topic of, well, so where do we see that going? Where are investments being made? Where is the M&A happening? What are the trends that companies and investors are taking advantage of or foreseeing out of the general trends that we're observing in our market information that we gather? So I think I'll step now next and spend a few minutes having each of the speakers introduce themselves, and then we'll start with some questions, and hopefully this gave us some initial fodder for thinking. So maybe from left to right, we'll start with Matt.
Hi, I'm Matt Freeman. I'm a partner with Bain Capital, and I work on the operating side of the private equity firm, which means I work primarily on companies post-acquisition on enhancing value. And prior to Bain Capital, I spent a number of years at Interpublic Group and at Omnicom Group on the media, digital, and advertising side of the business.
Okay, Urs.
Hello, I'm Urs. I run Bertelsmann's corporate venture fund called BDMI. Bertelsmann is a big media company, not that well known, but you will know the divisions that they have. Penguin Random House will be the book publishing division. RTL is our television division, which also owns Fremantle, so some of the TV shows you might watch. And then also magazines in Europe and services as well. And we are an early stage venture fund, $180 million, investing in A/B rounds in the media space, things where we think we can kind of make a difference and have an edge. We are set up pretty much like a normal financial VC, so carry structure and kind of behave pretty much like another financial VC would. And yeah, we also have a separate seed fund, and I co-invest with Scott from time to time.
Yeah, Scott.
I'm Scott Levine. I'm a managing director with Time Warner Investments. We do, in fact, co-invest with Urs and our friends at Bertelsmann. Time Warner Investments, we're the strategic venture group for Time Warner Inc. So Time Warner owns Turner and Warner Brothers and HBO. Clearly a lot of big disruption happening in the media space, traditional media space these days. So we look to make investments that we think both would be a good from a financial return, but also ones that would be of interest strategically to any one of our groups. We spend a lot of time in digital video, spend a lot of time in ad tech, spend a lot of time in gaming, next-gen web publishers, investments that we think would give us a good edge in terms of new cutting-edge innovation that could also help out our divisions.
Hi, good morning. My name is Tuna Mobi. I'm Senior Equity Analyst, Media and Entertainment at S&P Capital IQ. I'm responsible for overall broad media and entertainment coverage on the equity side, also overseeing the consumer discretionary sector coverage. I've been involved in the TMT space in various capacities, including a prior stint at Lehman Brothers for upwards of, I'd say 20 years. So I have to say that this is a very, very dynamic time to be following the industry, not the least of which is because of the shifts in media consumption. So presently our coverage, spans the whole gamut of publicly traded media and entertainment companies across various market capitalization. We interact a lot with, company management at the corporate level, and also sometimes at kind of divisional levels. So we kind of get a pulse of what's really driving a lot of the activity. A lot of these firms have, outposts, corporate VC firms. So we kind of keep an eye on the M&A trends and try to get a sense of, the disparities or any kind of relationships between public and private valuations. So, that's kind of, what we do.
Good morning, Mark Boydman. I'm Managing Director at Peter J. Solomon Company. We're an investment bank focused on mergers and acquisitions advisory. That means we represent companies on the buy side as well as companies on the sell side, meaning we help companies buy companies and we help companies sell visions. Media effort. I spend most of my time on media outside of the home. I've been doing that for the last probably 7 years, although spending time in M&A for the last 15. You might say, well, why did you want to spend time with media outside of the home? Believe it or not, 75% of our waking hours are spent outside of the home. And with mobile, media consumption outside the home is becoming more and more important. So we're very focused on associating ourselves with companies that spend time outside of the home. We also do cover media companies, though, that provide services within the home, but we really, really are liking outside the home, companies outside the home.
Great. All right. Thanks for the introductions. And you see we have a good mix of investment bankers, we have analysts covered, and we have investment coverage, so direct investment coverage. And so maybe I'll start with our analyst, Tuna. I hit a couple of high-level topics that we've seen in our own surveys that we generally see as trends: increasing use, increasing to the video, increasing to designated channels, or interest in multi-channel networks. And what are you seeing as sort of the macro trends as well, and that are driving some of the investment behavior?
Well, I think if I have to single out the main driver that we're seeing, I think it's the over-the-top. Shift to over-the-top, online video programming. A lot of companies have become sensitized to the potential threats that over-the-top, delivery, companies like Netflix, Hulu, and Amazon, and then you've got a whole bunch of upstart players. The cable industry, the pay TV industry has anticipated some of these trends, and they've, tried to introduce TV everywhere as a potential, defensive weapon. But the jury's still out whether, the threats from over the top are going to be contained. Now, I think there's a lot that's being made about cord cutting, basically millennial viewers dropping pay TV subscriptions. I think that has highlighted the potential, risks and opportunities as well from over the top. So over the last, month or two, we've heard, major announcements from companies like HBO or ESPN that have decided that the shift in media consumption warrants taking a lot of this content direct to consumers as a standalone offering. CBS, you name it. So I think the most important element of that is the idea to have sports networks actually as part of the package that's being offered, which is arguably the most expensive type of programming out there. So when ESPN and NBA, for example, decide to launch an over-the-top offering, or when Disney decides to make ESPN part of the Dish Sling package, we think that's really a watershed moment for the industry. As an analyst, I have to look at that and say, what does that mean for the industry, and how do companies confront the challenges of monetizing this over-the-top, which is what just about every company is kind of wrestling with. So we've seen an emergence of various kinds of models. Subscription models have tended to dominate what we're seeing right now, but there's no reason, for example, for an ad-supported free type of online video offering not to kind of emerge. Think about Spotify, what they're doing on the music side, the ability perhaps to convert some of these free users into paying subscribers. So in sum, I think there's a bunch of other themes that I can get into, but I just wanted to single out that. And what we hear from a lot of the companies we cover is the challenge in trying to monetize, a lot of the viewing that's current additional platforms. Most companies realize that, there's a lot of money being left on the table, and how do you kind of, be able to capture this viewership and be able to monetize that? So I think that's really the challenge, facing the industry. We talk about, over-the-top viewing, DVR, VOD, et cetera. So expect to, see continued focus on that front.
Great.
So one other point on over the top. I think there's an important distinction between over the top, I think, and a break from the pay TV ecosystem. TV Everywhere, which is in the pay TV ecosystem, is also over the top, but it's not such a big change to the ecosystem. I think what is a big change to the ecosystem is companies like Netflix, like Hulu Plus, like what NBC just announced yesterday, like what ESPN announced with their over-the-top $100 World Cricket package, that programmers are offering up packages of content that do go over the top. They may go direct to consumer or they may go through digital distributors, but again, it's content that consumers can receive outside your Comcast package or outside your Dish normal package or come on cable. And I think this is really the interesting thing to focus on. Can content companies maintain their favorable economics they have in the pay TV ecosystem with its affiliate fees and ad revenue, but then also try to capture cord nevers or cord cutters and monetize those users as well through these additional or supplemental packages. Netflix has certainly proven that there's appetite for this, for content outside the pay TV ecosystem, and a lot of companies are experimenting. CBS is experimenting, NBC is experimenting, ESPN is experimenting. Remains to be seen how all the dust settles, but I think it's now time for the media companies to try, because unlike 10, 20 years ago, it's now getting to be cost effective and technologically attainable for media companies to pipe in their own content and not have to lay fiber or lay copper down to the curb.
So do you see, so it seems that you talked about the pay TV providers and the content providers, but what about the social media providers? Do they ultimately move to creating their own content and brought it over the top as well?
Well, everyone's different. So for social, Facebook has made a clear decision a long time ago that they don't want to be in the content licensing business. They'd rather be the platform that content companies bring to their doorstep, like the NFL and their licensing package to Facebook. Twitter, I think, has done the same. YouTube is a little bit different. They have paid for some content. Usually it's paid, for UGC stars through YouTube, paying them advances. They have not paid for what we would consider content you'd get on pay TV packages, with the exception of maybe the D-League for the NBA, but not so much. So it remains to be seen if the social companies have the appetite to pay real big money for content, but remains to be seen.
But you do see a trend of brands becoming media companies, so they produce more content now. So that's another player in the mix that I think 5, 10 years ago was definitely not as prevalent.
Sure. Yeah, although original content creates stickiness. And so if you think of what LinkedIn did by acquiring Pulse, providing its own content leads people to spend more time there. And so I think that you will see social media companies decide to spend money and develop original content because it's important to them to retain their audience. Today, it's all about aggregating an audience. Once you have that audience, that's it. You've done it. So once you have the audience, though, you have to make sure you maintain that audience. And I think original content clearly is the way to do that, which is something that Netflix has been very successful at doing. And I love Netflix. Why do I love Netflix? Because it works, right? And once you experiment and you have users who like it and know that it works, they're going to continue to use it and go back there for that content.
And Mark, we've seen a number of large transactions. You've seen Disney, Maker Studios acquisition, the DreamWorks, Awesomeness TV, a number of other transactions. Can you talk about those as well?
Sure. I mean, I think what you're seeing in those deals is a land grab for non-traditional programming. And so a lot of these deals initially, when I heard the price tags, I was like, does that make sense? And how do they rationalize that? I think a lot of these deals relate to the fact that this is non-traditional programming. There's going to be several companies that actually have channels that work. Again, if it works and you use it and you like it, you're going to continue to use it. I think it's important for big media companies to have a presence in non-traditional programming, because if it does work, which we're seeing that it is working, ultimately you want to be on the right side with a non-traditional programming avenue. So I think that's been driving a lot of these deals. But what's also unbelievable, when you talk about the prices that people pay for these deals, when you see that they are reaching, in some cases, 30 million people are watching some of their programming. I mean, that's more than probably some of your favorite shows. I don't know, The Sopranos, Breaking Bad, you know, the season finales, all together aggregate shows, which in a typical audience for a season finale. And these non-traditional avenues are reaching those kinds of viewers frequently. So the values, in my opinion, are justified, but it's not easy when you try to digest the numbers. But it's all about, again, aggregating the audience.
So on the value proposition, maybe Matt, this question to you. This is like audience capture play, but how do you monetize it? What is the thinking around some new monetization schemes or ways to capture that value or to basically recover the investment that these acquirers are making?
How do you avoid trading dollars for dimes?
Yeah.
I think, you know, look, in our portfolio, the Weather Channel is a good example in many ways. You know, in many ways, a very traditional cable content provider, but also, it may surprise you to know, one of the top 5 mobile companies in the world, and now one of the most important data companies in the world. So I think there are treasure troves to be found even in the most seemingly traditional companies when you step back and look at them in a slightly different context. You know, obviously weather affects all of us. It affects as people, it affects us as consumers, and the ability to be geolocated, micro-targeted. These things are obviously good for the consumer, but also good for the advertiser in the same process.
Well, you know, I've talked to a lot of these companies that are buying up these and asked them precisely the same question. How do you kind of justify, you know, those kinds of investments, whether it's, Disney or DreamWorks, and you get this same answer, which is basically, look, they are not 100% sure, but they do know that these assets could be vehicles to create new franchises. And there's a whole host of potential opportunities to monetize, such assets, whether it's kind of, for example, DreamWorks has talked about, trying to, build a kind of a linear channel off of some of the assets that are sitting there that potentially have yet to be exploited, Disney as well. And when you think about a strategic buyer paying the kind of prices they're paying, I think it's easier to perhaps justify today, because my sense is these companies are willing to step up more and bid for these assets because the opportunities to leverage them across various platforms is something that's not readily available to a financial buyer. So that's why you're seeing more competition in some of these kind of small type deals for these kinds of assets. If you look at Awesomeness TV, or even some of the other, the viewership has been phenomenal, and these companies have been able to kind of even grow the asset further. DreamWorks, for example, had a deal with Hearst, recently that valued Awesomeness TV, kind of the 25% stake for about, $80-some million, which is several orders of magnitude higher than what they paid for the asset. And you can look at the numbers and see why they're investing in them, even though they're making very little money. And as an analyst, you have to look at that and say, how do you justify that and what's the upside? And you quickly realize that this is a long-term, play.
And I think it has to do with the audience. You mentioned millennials. An example I always use is you should go to VidCon, which is kind of the big conference for all the YouTube space. And last time I was there, there was I'll not name the celebrity, but there was a real big Hollywood celebrity with his entourage, like 10 people. No one cared. like not a single person walked up and asked for some, and then the Fine Brothers, two YouTubers, walked past, and then you saw 200 screaming young girls running past. And I almost wanted to go and ask, how does it feel? Because I'm sure the celebrity was expecting something else. So I think that is a little bit the fear of what happens to this young demographic that spend all the time on YouTube, or if they're male and gamers, they spend hours on Twitch, and that's time that they don't spend consuming the traditional media channels that the parents would have experienced or consumed. So I think it's a little bit of that. They don't know, how do I reach these people, and that's.
They don't want to lose that generation.
Yeah, right.
That's good. So, Urs, while coming over to you, you introduced yourselves as a strategic venture fund or venture capital. So, tell us a little bit about what that is, a little bit more about why that's driving a bit of the deal flow as well, and emerging technology deal flow. So, tell us about that.
Sure.
Scott as well.
So I think generally you see there was a lot of corporate venture activity in the pre-bubble space, and then I think it died down quite fast. If you now look in the last couple of years, I think the last 3 years it was something like 500 new corporate VC units were created in the last 3 or 4 years alone, all over the world. So it's definitely a trend that is happening, that big corporates want to find a venue or a vehicle that can bring some innovation into the big parent company. And I think we're just one tool of a big tool set of what a big media company can do to be innovative. I mean, they still do strategic investing, they do acquisitions, they do joint ventures, but they also do corporate venture capital. And so what we do is we invest early, we behave like a normal VC, but we make sure that we link up our portfolio companies with our parent company. I can even use an example. StyleHaul was one of our portfolio companies. I let the be around. It's a large YouTube MCN in the beauty and fashion space. And after we invested, we made sure that they had a production deal with Fremantle. I mean, you can't force these things. It's like you make the warm introduction, and I think both sides take the meeting and are very positively predisposed when they meet. But it still has to make sense on an individual level to make those deals. So we hooked up StyleHaul with Fremantle. We made sure that all the other television executives knew about them and met them from time to time. And then at some point, I think we had them in our portfolio for 18 months. Then RTL decided to buy them. So but it's a rare outcome actually. I think it's the first time a company in our portfolio ended up being acquired by our parent company. Right. And we were not set up for that, because then you have a different mindset. If you have an M&A view on corporate venture, you behave differently than if you think, no, this is about helping young startups and bringing some innovation to your parent company, then you behave a little differently. We sold 9 companies in the last year alone, and so only one ended up at that. So it's really the rare case. And then very often I get the question, so did they have any special rights, matching rights, topping rights, something like that? And we don't do any of that. It was a very normal arm's length transaction. There was a banker involved to make sure that there's no funny business happening. And I think that's just one of the ways how we add value. So the parent company got to know StyleHaul for 18 months. And by that virtue of that, they formed an opinion whether they like it, which is sometimes easier to do that over 18 months than if you fly in an M&A team and have to do it in 2 months. And also, I mean, some of the other things is that we do for our parent companies. We organize trips. We make sure that we funnel interesting startups to our parent company, which, by the way, the startups love. So it's free biz dev. They talk to us for funding, and we introduce them to our book division. We introduce them to television. So I think it's a great value add. And my view on the venture space in general is that you have to have a special sauce going forward. If you're just redistributing money from LPs to direct investments, there's a risk of being disintermediated by something like AngelList or some avenues like that. So I think our special sauce is we know the space that we invest in quite well. We think that we can be quite helpful with making introductions. And that's, I think, why people like to take our money.
Scott, why are ventures, it seems like increasing, corporate ventures or captive venture funds? So tell us about that.
So I can't speak for all corporate ventures and why they're expanding, but certainly it's as others say, when you set up a corporate venture fund, you really or a venture fund aligned with a company, you really do need to pick your focus, and you need to have what value you bring to the table. Like Urs at Bertelsmann, we are very much specialists in the digital media world. We know extensively how the TV business works, how the movie business works, how the over-the-top video business works, how digital publishing, mobile ad tech works. We don't spend time in fintech. We don't spend time in e-commerce. We don't spend time in hardware, semiconductors. A lot of areas of VC investments we just don't look at because we really find we want to be in these areas. We want to be in areas that we think could help drive innovation at the company. Certainly, operators across all of our divisions are always looking for innovative new ways to increase their business and to grow. But they also manage large P&Ls. Right? It's a big company. For us, this is our day job. We meet with on the order of 500-600 companies a year, and it's our business to know everybody who's doing anything of interest in the space. If you're running CNN.com, it's a big P&L. You may not have time or the bandwidth to really keep on top of everything. Now we keep in close touch with the people at CNN, the people at TMZ, the people at Bleacher Report, the people at HBO, and we probably spend a good quarter of our time just interacting with all these groups, make sure that they know what we're seeing, make sure we know what's of interest to them, so we don't go too off course. But also we want to ensure that we're not looking too near term. We want to really look kind of the kind of midterm, say single-digit years out in the future. What will be important for our business? Now, in terms of why other companies are growing their corporate venture groups, corporate venture groups are good in the sense that A, it can help foster innovation because you form great relationships in the space, and B, if you're doing it right, you're making money. So it's not as if we're a cost center to corporate. We generate real cash. It certainly helps with the budgeting process, and in a sense, we pay for ourselves, and it's a good way to keep everyone abreast on the space. It's if you didn't do it that way, you could always set up R&D groups. You can always set up more in a more distributed manner to help with innovation. We've seen that in other companies, and it's generally harder. It's harder because they don't generate cash themselves, and when tough times come, they may be the first ones to be cut. So, and I think a lot of companies in entrenched businesses, like media is a traditional business, going through a lot of disruption. The automotive space is a traditional business going through a lot of disruption. There are a handful of other sectors out there like that. It's a good way to keep on top of things. It's a good way, again, to really keep abreast of the sectors.
So you mentioned what's interesting to, I guess, your parent or to yourself. So what are the areas that you and in that role are looking to invest in? What are the more interesting areas that you're just saying?
So,
And just also hers, and then we'll compare that to sort of what Matt and Mike are saying in traditional banking sectors. Go ahead.
So one of the big areas of interest is the rapid change we're seeing in television and television advertising. How can television advertisers, how can television inventory owners like, say, Turner, how can we increase the value of our own TV inventory? How can we match our TV inventory with third-party data sets to show exact psychographics and demographics of who's watching? Can you show attribution to people watching TV ads to performing some other kind of action? Can you show that the value is higher relative to, say, where it is social or it is to digital? Or if not higher, can you at least justify what people are spending? Will the TV landscape become more like the digital, online, and mobile ad tech space? Very interesting areas. We have a few investments in the space. Lots of interesting change. In addition to this, we do spend a lot of time in the over-the-top video space. Everything from the infrastructure and the plumbing to make sure that people have good experiences in streaming video over the top, which is not trivial in terms of technical means. But then everything from aggregating content to content recommendations to user UI and user experience. People are certainly going to be watching more over-the-top video than less. And there's a lot of problems to solve in that stack. And we continue to move forward with investments. And the last item we spend a lot of time in is how do we understand more about our end users? Time Warner has traditionally, so our current divisions have traditionally been a media wholesaler. We package up TV shows and movies. We sell them to distributors like Comcast or movie theaters or Netflix, who then goes and sells content directly to consumer. That's not, through our websites, through our apps, through other touch points, that's not going to be the case now. We can know a lot more about our consumers. So how do you get more information on your consumers? How do you understand what their interests are? How do you personalize content for them? How do you market to them directly? A lot of interesting innovations coming out of the ad tech world that we've been investing in as well.
So for us, we have 3 sectors that we invest in. So we also consider ourselves very highly focused. And every couple of years, we sit down and analyze whether we think there's still venture-style returns in those categories. And if we, at some point, decide no, then we'll kick one of those topics out and add a new one. So we always want to be focused. One that we spend a lot of time on is very similar to Scott, and that's why we run into each other, is online video. And we call that the next gen TV. So it's a lot of it's on YouTube, off YouTube. It's the plumbing, it's video, ad tech. In the last couple of months, so that's 2 exits alone, and I need to reinvest some of those proceeds into that topic. So online video is great. Second sector that we invest in is what we call pub tech, publisher technology. It's all the B2B stuff to a web publisher or mobile publisher. So ad tech definitely is a big part of that, but we didn't want to just call it ad tech because we wanted it a little broader. So there's a content recommendation, or there's payment solutions like Vindicia, which I see the logo right there. That's why I was remembered it. So it's B2B things where we are a potential client, or we know all the other clients, and we can help you get some of those. So that's why we invest in them. And then the third sector that we currently spend time on is what we call next generation content community commerce. So those are either next gen publishers like the Elite Dailies that was sold a couple of weeks ago. I mean, one of our companies that we invested in is Mike Media, or Policy Mike is how they started here in New York, or Hello Giggles, Food 52. Those are all players that have a little different angle than if I look at how my own magazine publishing unit attacks those verticals. So it's either it's a site from millennials for millennials, or it's something like a Food 52, which is it's a wonderful community site. They have great content, also editorial content, and then they also start selling things. So they have an e-commerce component to it. So in a way, it's good to have something. If you're only dependent on banners, it might be interesting to also have a transactional relationship with some of your audience. So that's kind of, those are the 3 topics that we currently spend time on. So we, 2 years ago, kind of said no to gaming, no to music, which is, we all love gaming and music, but there is a benefit of being highly focused and knowing 30 people to call when you see a deal in online video versus having to learn it yourself. Kind of.
So Matt, we've heard about how potentially corporate venture is looking at something different than traditional money. So maybe you can talk about what you're doing or Bain's doing.
Sure. Well, I can speak to Bain Capital as an advertiser. So, in aggregate, our companies are a very significant advertiser, both in the U.S. and globally. And Bain Capital Ventures, actually, which is touches a space closer to where you guys play, is perhaps another good point in. On the advertising, the biggest theme that we see is there's a re-empower, and the leverage in many ways has come back to the brand money that's been somewhat imperiled in many ways over the past decade or so. I would say that there has been a re-empowerment of the advertiser, and you were mentioning brands as media companies. I think it's pretty accurate. If you step back and sort of normalize an impression value, I think a lot of brands are realizing that, hey, you know what? If we make an investment in content, it may actually pay greater dividends and be more, of a recurring benefit to us than through traditional paid advertising. That doesn't always mean that the traditionals are cut out of the loop. I would say, Canada Goose, which is one of our companies, actually partners more directly with Sundance and TIFF and others to actually get closer to the content in film. Tom's Shoes, which has sort of been built from a very ground up, socially strong perspective. They I would say embrace content creators even more directly and more deeply than I've seen some of our paid advertisers do in the past. On the venture side, a lot of the theme has been around marketing infrastructure, and whether it's Kenshu or Jet.com, it's been interesting to watch advertisers regain control of that marketing infrastructure, which has been so intermediated over the past decade that I think they lost a bit of control over where their dollars and their data were traveling before it arrived at media companies. A lot of that power and the leverage of the dollars spent has been regained, which is a really interesting trend to us.
Do you see a trend at all towards more partnerships as opposed to investments, acquisitions, venturing? Is that something that we'll see increasingly amongst the media companies?
I think there's always partnerships happening. The media companies in particular have been active on the investment front. Us, Bertelsmann, Advance, Hearst,
Comcast
Ventures, right? So they've been quite active. But I think it's important, as Urs mentioned before, when we invest and most of our brethren invest, we invest like financial VCs. That we make sure that there's a clear delineation between our money coming in as investors and it not being tied to any biz dev deal. It's not saying, great, we'll give you $5 million on a 40 pre, but you have to give us free access to your product for all of our divisions. Or we have a right to buy you in 3 years for a certain price, or we right of first refusal. These are very dangerous things to put in as term sheets. And it's very short-sighted. Like if you start doing that enough, no other investors will want to play with you. It's like, oh boy, that's strategic. He's really going to crush this company if he comes in. But with that said, I think certainly both are healthy. And oftentimes we'll look at a deal, we decide it's not for us, and then we'll bring it to one of our divisions and they'll partner with them. And if that partnership goes well, maybe in the future we'll invest, which happens often.
The biggest mindset that I've seen over the last decade or so, as far as the big companies, the strategic acquirers, I think there's been a paradigm shift away from the kind of quote unquote the mega deals, right. With few exceptions, of course, Comcast, Time Warner Cable. But I think you're now seeing a lot of these companies more inclined to do relatively small deals in $100 million, couple $100 million range. I have to say that it's not for lack of liquidity. A lot of these companies are sitting in piles of cash. News Corp, for example, Fox, 21st Century has upwards of $10 billion cash sitting waiting to be deployed. Yeah, they're doing a lot of these companies share buybacks, modest dividends. Disney north of $5 billion. I mean, these are not extremely high levels by technology company standards, but by historical standards. I think there's ample liquidity. There's a lot of dry powder there, but you sense that the companies are a little hesitant to pull the trigger on any kind of major deals for a variety of reasons. And I think that's kind of a different mindset than we saw prior to the financial, crisis. So clearly, there's been more deal making in areas where the companies are generating new revenue streams, whether it's kind of retransmission consent, for example. You've seen television station deals kind of accelerate, coming out of the the recession. But in terms of the mega blockbuster deals, I think the corporate folks are maybe they're held to much more to be more accountable, and that's why I think they will step up when the deal is right and it has all the elements of what you guys are talking about. Relatively minimal investments with potentially significant upside. So that's the paradigm shift.
Yeah, I was just going to say, we're seeing more and more deal flow in the last year and a half because of the debt markets. So where a company might have otherwise decided to think about partnering, they said, well, why don't we just buy the company relative to partnering? Oftentimes, it morphs from partnering to acquisition, where it's a core competency that you need to own or want to own, and you need to scale. It migrates from a partnership to an acquisition. But you're not going to see somebody like Uber acquire Spotify. They're going to partner with them to deliver Spotify in their cars. That makes sense. It doesn't make sense for Uber to acquire somebody like Spotify. So partnerships, there's a thought process that goes into, should we partner, should we acquire? But at the end of the day, in a situation where you've got very attractive debt markets, if you're on the fence, I think companies will be more inclined to make an acquisition. If the debt markets were to shift and it becomes less or more expensive to buy companies, I think you'll see companies partner more often.
And maybe one thing to add there, you asked about which way are there more investments, more partnerships, or joint ventures? I think, at least for my own parent company, I think we do a lot more in all of these. So I think there are more joint ventures, more partnerships now than I've seen 5-6 years ago. So I don't know, maybe Scott can say how it is in his company. I think our company they were less active 5-10 years ago. And now if you look, there's a joint venture with Fremantle and Vice for the Munchies and like for Food Channel. So I think it's something that might not have happened 5 years ago. I think at least my parent company, I think they were a little bit more isolated and thinking we can do it all. Like this is good premium content. I don't know. At least a little bit my observation.
I would say also from the acquisition side, I think certain sectors are more aggressive than others. Media has not been as aggressive. Maybe the biggest one of late was Disney buying Maker. But in the tech space, Facebook, very aggressive, spending real money on WhatsApp, spending real money on Oculus, right, for a company that has no revenue to speak of. But also, Facebook is a very fast-growing company, even faster than the media business. Right? So yeah, rapid growth, and they have a huge amount of cash and a high, currency in terms of where they're trading, and they're able to make these kinds of acquisitions. It would be tough for a media company to spend $18 billion on a mobile messaging app, for example. We would be crushed in the markets, I would guess. I'm not an IR guy, but for Facebook, it went very well, right? Because they need to continue the growth, and that's perfectly acceptable to them.
Or even $1 billion on Twitch, which was acquired by Amazon. I had one studio, Hollywood studio head, tell me, it shall remain nameless, that they kicked the tires on Twitch, but kind of the bureaucracy and the potential investment was they couldn't get it over the hump, and it's kind of one of those areas where he felt like something got away that should have been a great acquisition for the company, but it kind of illustrates the dynamics of kind of some of these deals when it gets to a certain threshold and the potential bureaucracy that can impede the corporate acquirer versus some of the non-corporate.
You hit on two companies there at Twitch with the gaming specific video channels and Oculus and the immersive technology there. I mean, what do we see as the future in those two spaces there? Where are the investments going to be? What's the opportunity there?
Sure, yeah, I'll take that one. I think that what people need to understand, and this relates back to my comment at the intro around media outside of the home. If you think of Oculus, the future is, instead of me having to go to a physical store, I could just put this device on my head, and I can actually feel like I'm walking into a store, my favorite store. I'm actually picking out the merchandise, and I'm just paying for it, and it's in my cart and shipped to my house without actually having to leave and go anywhere. That's potentially the future. That's probably quite a ways away, but that is potentially the future. I think we're very bullish on assets that bridge the physical world and the digital world. So we're very bullish on beacons, for example. We think beacons will become a part of everyday life, where, if you like it or not, you will get push content to your mobile phone when you walk into somewhere where you want that content to be pushed to you. And if you want that content pushed to you, you want those offers pushed to you, that will all happen. It needs to happen. The physical world needs to embrace it, because otherwise they'll never level the playing field with online. And if you're a brick and mortar traditional retailer today, and you're troubled by the fact that less young people are walking into your store, how do you level the playing field with online? It's, again, bridging the physical world with the digital world. It's making investments in whether it's beacons, whether it's digital signage, anything that's going to improve your physical location. Allowing young people to share and compare like they do online in the physical world is very valuable because they're used to it. So if you don't provide that experience, that experiential environment in the physical world, I think you're a tremendous risk. So we really like companies that do that, and we think that's a huge area for investment and opportunity.
I was visualizing putting a headset and walking down the street and trying to play those two. But yeah, and we're seeing.
I'm sorry, just to follow up on the VR front, I think we're also very bullish on VR, and we're actively spending time looking for new investment opportunities in the space. If you haven't tried on some of these headsets, it's hard to really explain. I saw the most recent Crescent Bay headset from Facebook/Oculus, and the quality now is just really incredible with the newest headsets and the newest gear. People are looking at using VR for watching live sporting events. People are looking at it for concerts, for education, certainly for other kinds of short form entertainment. There's always a question when you're investing in a new space like this, when it's too early. Facebook clearly thought it was about the right time. But in terms of media companies, we are mass media, right? We look for media that can have a lot of distribution. Right now, there are not a lot of headsets out there. That might change very rapidly with Samsung, offering up headsets that you can plug your phone into, and almost everyone has a smartphone these days. Sony's launching theirs. Oculus, of course, is launching theirs.
Google Cardboard
as well. So these very low-cost headsets that you can plug your phone into. The quality is not as great as these very high-end headsets, but it's still an interesting experience. But I think it'll have a place in terms of media entertainment, whether it'll be long-form entertainment, like will someone want to watch a whole movie with a headset on? I'm not sure. Will people be interested in watching a 3-minute clip or engaging in a 3-minute environment? That might be more plausible. But certainly an interesting trend, and HBO and Warner Brothers have both done tests and put out content there. It's very well received.
Do you think they'll do better than the 3D glasses that no one wanted to wear?
Even better than the 3D glasses. Yes, that's a very low bar. But yes, I think much more so.
Yeah, just the last point on Twitch. I think that what people need to also understand, and I thought the comment around not spending time investing in gaming is an interesting one, but if you think of any screen.
We do know Twitch though. So
yes, so any screen, what's the number 1 or number 2 activity that somebody does with that screen? It's play games. So this is why we think gaming is a very interesting sector and one not to be ignored, because as more and more screens are in your environment, again, bridging the physical, digital world, your mobile phone, you're going to be spending more time with games, both game development and games distribution. So we do like that sector, and we do think it's an area worth spending time in.
And talking about games, look at what Disney has done with Infinity. Is nothing short of phenomenal. And so you take something that no one was even barely paying any attention to where it now becomes profitable, and not just profitable, major driver. And Disney obviously unique because they've got all these kind of characters, but it just kind of shows you how companies can transform, or kind of gaming has become obviously a much more dynamic field than it was when we just had the console, the old console experience. Now it's kind of become much more integrated with social, etc. So I think that's the way that a lot of companies approach it now.
Yeah, I'll just say, as a father of 3 boys, I would have to concur. Like, you ignore gaming at your own peril. Look, the gaming as a business is tough, hit-based, all that, franchise dependent. But gaming as sort of a mechanism that is being blended into shopping, into community, into all kinds of different human behaviors, I think is a very real trend. I would also, to your point about out-of-home media and sort of a re-acknowledgement of the power of it at scale. One of our companies, iHeart/Clear Channel, is to me a great example of that, where you look at the Stayed billboard, which is suddenly this incredibly informative beacon and nexus of information and directive for advertising. I think there will be a shift of power in out-of-home as well, toward players of scale that are able to pivot and attract the audiences and their out-of-home behavior, which is, as you said, the majority of their waking time.
Mm-hmm. Yeah, no, agree.
What else is in that 75%? My curiosity.
No, look, I think it's a very it's becoming more and more relevant with mobile, because as you're more mobile and you're on the go, I agree with that comment about out-of-home media, because when you're closer to the point of purchase, when you have your phone with you and there's information and content that's distributed to you, whether it's advertising content or actual media content, you're more likely to act. So
It
if
is
you are
so
on the go,
true.
you are more likely to purchase something, more likely to do something. So again, we really like out-of-home media. It's broader than just advertising. It's really, going somewhere where Wi-Fi is becoming more and more prevalent, being able to take out an iPad or a tablet device, putting on Netflix. You can consume content where you otherwise would not have consumed content. That is now, and like I said, you're going to go to things that work. So Netflix works. You're going to be able to watch your content almost wherever you want, where you can have a connection. So we like platforms that work and are proven, which is why we really like companies that do that, and the technology piece works. So Netflix is more than just a media company to us. It's really a tech company in many ways.
I started off as an advertising creative, and trying to get over the inertia of the couch is just such an incredible challenge. I mean, it was then, it is today, but I think, finding ways to connect with people closer to sale we are just at the beginning of a new era.
You mentioned iHeartRadio and just something we hadn't talked about, radio, and some people said radio.
Radio is the largest out-of-home medium that exists. I mean, it's, trade marketing close to sale, it's whatever you want to say. But again, to me, it's easy to chase shiny new objects. It's sometimes, for advertisers especially, more interesting to look at established media of scale and use them in a slightly different way. And Bob Pittman's done a terrific job there, both with the festivals and starting to work with broadcasters and creating content on TV in a different way, but also on the mobile side. I mean, the app and the growth and the prominence of iHeart really has been a tremendously creative value for the business.
And imagine it's just opening up increased advertising potential there that you have through your mobile app now that you didn't necessarily have.
Huge. Yeah, exactly right.
There was a question, I think.
Yes, I'll pause now, and I think we can ask a few questions. Go ahead, up front.
I just have one quick question for Scott and then a follow-up for the panel. Scott, you said it's now getting to be cost-effective for content companies to go over the top. Can you explain that a little bit more? And also for the panel, just want to get your thoughts on M&A possibilities for the pure play content companies out there like AMC, Discovery, and Scripps. So those are my two questions.
Did everybody hear that, or? Sorry. So the first question was why is over the top? Why is over the top more cost effective today than it has been in the past? And then I'll ask you to repeat the second one. Sorry.
So for the first question, for cost effective, say if you wanted to stream video over the top, 20 years ago, you'd have to rack and stack your own servers in your own data centers. Bandwidth costs were extremely expensive, orders of magnitude more expensive than today. No one had the bandwidth to support it at home. There were no connected TV devices. There was no mobile. There's no iPad. Today, you have devices everywhere. Bandwidth has gotten much cheaper than before. You don't have to rack and stack your own servers. You can go to Amazon or Google or Microsoft to do the streaming and then hosting and ingesting. DRM, there are a lot of companies that'll help you do it. You don't have to do it all yourself. And not the whole stack has become commoditized, but a lot of it has. And there are a lot of providers out there that'll help you do it. And that just wasn't out there. The economics just didn't work, and the infrastructure wasn't there.
And the second question is just to get your thoughts on potential M&A. Just to get your thoughts on AMC, Discovery, and Scripps as potential M&A targets. They're pure play content media companies.
Well, if I can chime in on that one, the M&A is just about the top question we get from media investors, and kind of how much more headroom you have given the deals that we already kind of most of the major deals have been on the distribution side, whether it's kind of Comcast, Time Warner Cable, or AT&T DirecTV, Charter as well. So to your question on the content side, there is a feeling that in the kind of the play for scale is going to drive a new wave of consolidation on the content side. And I have to agree with you that some of those companies you mentioned have been speculated as potential candidates in this next wave of media consolidation. Obviously, I think a lot will depend on what's the outcome of the deals in front of the FCC with Comcast and Time Warner Cable, as well as DirecTV. And all of this is happening in this climate of regulatory overhang with Title II and net neutrality, which creates the possibility that some of these deals could in fact be, shut down, although that's not what we expect will ultimately happen. So if these major deals on the distribution side go through, and with all of this noise we're hearing about retransmission consent, all the kind of the takedown, channel disputes, et cetera, I think you're likely to see this kind of environment to motivate some of these smaller content companies to come together and begin to explore merger scenarios. And in fact, I do believe that that's already happening, but nothing yet public. So we think that there is definitely potential.
I have 2 questions as well. Can you hear me?
He's bringing the mic over, so if you wait.
One has to do with the impact of net neutrality on the whole deal-making scenario. Is it a positive thing or a negative thing? Really, what is the impact from an investment M&A portfolio, VC investment point of view? And the other one was a thought of over-consolidation. I mean, when you're looking at the towers of who's aligned with whom, it seems like it's getting narrower and narrower. And is that a positive thing? Should there be more diversification?
So maybe the net neutrality one. I mean, you're talking to VC here. Our business is to invest in very small companies that hopefully take on big companies. So generally, definitely, we want there to be kind of a net neutrality in play. Otherwise, the big companies can prevent the small companies we invest in displacing them. Not sure whether my parent company would give you the same answer to that question. So that I might be biased with my day-to-day operations.
Well, I can certainly tell you that it's not perceived as a positive, in the kind of the publicly traded company, big ISP kind of world, whether it's Comcast or Verizon, for obvious reasons, right? So I think, the threat that the regulators might ultimately start to regulate broadband pricing, that's something that investors, are closely watching. And I'm sorry? That's right. And I would argue would have a very negative long-term consequence on the return on investment for the sector. Because companies that have argued that all of these investments, billions of dollars, wouldn't have happened. Now, there's some, there's both sides of the argument, right? Obviously, the consumer would benefit, I think, from having more control. But ultimately, I think as an investor, you have to look at that and wonder, how much, more, how that could affect innovation. Now, listening to all of the different ISPs, there's a divergence of view. Some of them think that's not a near-term threat, it's nothing to worry about. Others are more vocal and they're kind of up in arms, and you're likely to see litigation either way. But ultimately, from an investment perspective, I would have to say that it's a major overhang, it's a cloud, and a potential negative.
Gentleman sitting right to your left, the mic.
Hi, Dorian Ben Coyle, Teaming Media. You talked about investment in content in terms of M&A. There was a sort of the common wisdom, 18 months, 2 years ago, was content was not attractive to VCs or that kind of money. Recently, content does seem to be attractive, at least, BuzzFeed and Vox being 2 examples that have gotten new rounds of financing that, value them close to or more than $1 billion. So what is it that's making these kinds of content companies attractive to venture and, venture capital and that kind of forward-looking money, do you think?
Sure. So at Time Warner, we've invested in two of these media companies. One is Mashable, and the second one is Bustle, a younger company that's young women focused in Brooklyn. I think you're right. Content has kind of gone out of favor and now back into favor. There was that giant round from Andreessen to BuzzFeed. And I think a lot of the interest around these companies is that, unlike sometimes a lot of the traditional media publishers, these companies have figured out a pattern for low-cost content production, figuring out what content to produce, how to get interesting sponsorships with brands, and how to get a lot of traffic from social. And I think all these factors, as well as building in their own content management system, their own kind of proprietary CMS to handle all the plumbing of producing media. I think it's much different than traditional businesses, and they've shown fantastic growth and solid financials. There's also been a big push into video in terms of video production for all these companies, which video monetizes much better online than current articles. I think a lot of these companies, and what I've read at least about what Andreessen sees in BuzzFeed, is BuzzFeed they think is much more of a tech platform than traditional media. Before, you say if you're a movie producer in the media business, it's a very hit-driven business, like producing games or producing big tentpole movies. And that's traditionally been tough for a venture investor. But if it's a platform or a tech platform, and perhaps more predictable, more steady, then I believe that's why new investors are coming in.
Of course, I think. Sorry, no, I was just going to add that there's infinitely more ways to monetize this content today than was the case, maybe even 5 years ago.
Great. There's a question in the back there.
Thank you. Yeah, does the fact that ad tech companies are getting killed on the public investment side change your guys' investment strategy on the private side in any way, especially now that more and more media companies are focusing on technology?
I think, unfortunately, it does. I mean, the sectors come in and out of favor, and even though VCs generally have a kind of multi-year horizon, when we make an investment, we don't expect to sell them in the next 1, 2, 3 years. It's still, I can't say, I think if you generally ask the sentiment of a lot of VCs towards ad tech, it is not super positive. I mean, because ultimately, I mean, that is one of the exit channels that you expect, and if they're not doing well, they're very likely not acquiring your startups. So even though there is a time lag, definitely public markets have a significant influence on sentiment of VCs as well, I'd say.
So I would answer a little different. I think we're still bullish on ad tech as a sector, but because the public markets have gone down so much for certain pockets of that public ad tech, it certainly helps as an investor to come in at a lower valuation, because you can say, how could you be asking for this kind of multiple on revenue when the public comps are down here, right? And it's tough. Conversely, it's tougher for an ad tech entrepreneur trying to raise, because a lot of the exits, even at much larger scale, are not getting that much of a premium.
I'll just say, as an operator, they're becoming more central than ever. So, there's a lot of chop on the surface, public markets, things like that. But fundamentally, operationally, they are becoming more important, not less.
Any last questions? I think we're coming up to the hour. No? Okay, if not, I want to thank our panelists. I appreciate your time and the insight that you provided.
Nice to meet you. Nice to meet you. I'll give you my card.